We are back with another episode of the Do As I Say, Not As I Did podcast. And as always, the name kind of explains everything. We're giving you advice based on everything we did wrong the first time. I'm making assumptions on behalf of my guests here, but at least everything I did wrong the first time. Each week I bring on founders, investors, product experts, technology futurists, sales gurus, and just about anyone who is very smart and can help us work out how to build a great business. And then together we answer your questions, the ones that you send through about what's going on in your lives and in your businesses. And just a quick note here. The guests have never seen these questions, so they're hearing them live just, at the same time as you are. So if you do have questions or you're trying to put out fires, send us through an email. We're going to workshop it on the show. So send those emails through to podcast@joelditrapani.com. And I know I've had the feedback. That is a hard email address, and that's totally fine. I'm going to put that one in the show notes so you can just copy and paste it later on. I'm your host, Joel DiTrapani, and I'm the co-founder and co-CEO of Vigo, which is an AgTech scale-up we've been growing through Australia and the UK, and we now focus on the US, which is why I moved to Austin this year. On top of that, I'm an advisor and a coach in the product space where I help startups and businesses work out how to actually run great product teams, because that is the secret to building great products. And that is what I had got wrong for 5 years before in the beginning years of my business. So look, today I'm super excited to be joined by my friend Pat Moody, a guy that can read a P&L better than anyone. Pat has had an incredible run in the startup world. He kicked off his first business during college where he started Burassi Apparel, a clothing business he grew for a couple of years before leaving that and joining the team at LawnStarter as employee number 1, where he moved across the country to Austin and went through one of the best accelerators in the world, Techstars, with that team. After this, Pat then joined the student-managed investment firm, Virginia Tech Seed, and quickly became the chief investment officer. Pat transitioned from that investment firm to S3 Ventures, which had $900 million under management. And then after taking around 10 board seats, he decided to go all in and join one of the portfolio companies he was helping out, which was Atmosphere, where he now runs finance. So Pat has seen a P&L from every possible angle, and he can tell you when a company is in trouble or about to scale rapidly. But more than any of this, Pat runs incredible events and literally knows every person in Austin. When I moved to Austin, for months, every single person I met said, "You have to meet Pat. He is the guy." And so very quickly I was asking for intros, and then I eventually met him, and they were right. Pat is the guy, and he does know everything about the ecosystem and every person in this freaking city. So just ask Pat if you want to meet someone in this space, because he knows them. Pat is an absolute expert at investment and an expert at building incredible networks. So let's jump into it. Welcome, Pat. Thank you so much for coming on today.
Thanks for having me, Joel. It's great to be here.
Look, mate, before we jump into the questions today, tell us, what are you working on at the moment?
Well, I've now been at Atmosphere for a little bit over a year. I work with the CFO, Mike Risco, the VP of Finance, Zach Miller. We're kind of helping build out, scale the company pretty well. It was our fastest growing portco at S3 at the time when I came on board, and we've been doing really well since. So it's been a fun time over there. But on top of that, as you mentioned, I do a bunch of these VC happy hours, a bunch of these kind of startup events, and that's really become a big passion of mine, especially in the Austin, Texas space. Just it's an awesome environment, tons of people moving here all the time. It's always changing, and it's a great place to be and a great place to kind of really do these events. So that's been top of mind recently. Hosted an event back in August, and probably will do one maybe early November or so. But yeah, it's great to be here, Joel. Thanks again.
Pat's events are intense. Like, there's a lot of startup events that happen, and the chances that you meet someone are pretty low, but it's, you still get to meet some interesting people. But you go to Pat's and they are like, I'm guessing he does vetting or something, because like everyone I mean, I was like, holy shit, what? How did you get all these people here? So it's, get on Pat's list, send him an email, and he'll add you to his list if you're in Austin. But it's definitely worth going and checking out those events because they're a lot of fun.
I was gonna say, and I can kind of throw in some information at the end of the podcast to kind of get involved in those events, and maybe I'll touch on at some point how I started them and everything like that as well. But yeah, it's been great. It's been great having you come out.
Perfect, man. Well, we'll definitely drop info to the show notes too, and so you can find out more about what Pat does and when the events are coming up. But let's jump into a challenge. So this challenge is called, "What should I be doing in those 30-minute intro calls with VCs?" My co-founders and I are first timers, and we're just starting the fundraising journey. I've had a few early stage VCs reach out through different networks and set up 30-minute intro calls. Generally, they tell me a little bit about the fund, what stage they invest, etc. Then they ask me to talk a little bit about our startup. I haven't been treating these as pitch meetings and have been very informal about explaining who we are, our idea, but now I'm unsure if I'm taking the wrong approach. They never ask to see a deck, which is why I'm more casual. Really curious to hear from investors and experienced founders here. What is the purpose of these calls, and should I be doing something more formal? Thanks. And this one is from Rigid Inclusions.
Excellent, Joe. Well, on that point, I think it is good to add an air of formality. You can add an air of formality while still kind of leading an informal tone. And I've been an associate S3 for 3 years, so I saw probably thousands of companies, and I felt the most successful meetings off the bats were ones where the founders definitely introduced themselves, so we got to meet them pretty well. Also establishing if they were interested in us as an investment partner, why we might be a good fit, and just showing a little bit more diligence up front on their end as we had maybe taken the time to better understand the company. From my experience, it does help to have a bit of a pitch deck, just a little bit of something to walk through. And it doesn't have to be a very formal, like, hey, I'm going to present this to you. But this is more just for me to throw a few graphics up there. And if this is the time I'm going to get from you, or you never know, especially because from, the founders end, your time is extremely valuable. From the VC's end, our time is pretty valuable as well. And you want to think that it's going to be the first call of many. But just how the world is, you never know when that next call is going to be. So you want to really kind of try to put it all out on the field without making it feel like that. You're just kind of doing that. So if you have a deck and you're able to kind of touch on the key highlights, it also takes a lot of pressure off the VC because they're not going to be scribbling down notes the whole time or whatever. They'll be like, hey, I can refer back to the deck. And so I think overall it does help to have something to walk through. It does help. And there's people that are more, visual learners and kind of listen, and also people that are audio learners that listen a little bit better, and people that are visual learners and listen a bit better. And having the deck and walking them through kind of gives those visual learners a little bit more of an opportunity to really see there. And some people also will remember numbers a lot more from kind of charts and bars versus just what you're saying. So from my experience, at least, especially at the junior side, it also made it easier to kind of summarize and show the team hey, really quick, this was a deck we ran through. These were some of the highlights. I think this would be worth a meeting, kind of next step. So I think it always helps to have something. And it also depends upon the environment. If you're just meeting up with somebody for coffee quick and maybe it's come through an introduction or you're just out and about, that's one thing. But if you're setting up a full formal Zoom call and kind of taking 30 minutes, I think it does help to have a little bit of structure to it. And like I said, just more so you leave what's on the field, you show them how great of a startup you're working on. And I think introducing, yourselves, the founders, really where you got the idea and, the problem that exists and why it's a problem. And not just kind of creating a product that's just solving a problem that you think is out there, but why it's a real problem in the world. Touch on things such as the market and market sizing. If there's a competitive landscape, briefly go into that. But just kind of hitting the high-level bullets. But, just from the very beginning of the question, I think that it is a good point to establish a level of relationship and stuff off the bat. So that's probably the most important thing. Even if it doesn't feel like a pitch, everything can always be a little bit of a pitch. Because if it gets the VC really excited, they're going to be like, hey, let me go back and talk to the team here and get a few more people on, and then let's set up another call. Yeah. Joel, has that been your experience as well?
Yeah, I think, mostly. I think I probably have an 80% overlap with what you're talking about here. So, I think the first piece of advice I'm just going to give here is read the book Fundraising by Ryan Breslow. It's a 50 or 60 page book, and it is exceptionally good. It actually tells you the scripts and the dot points you should be hitting in these meetings and the follow-up emails you should be sending and stuff like that. So if you want very, very tactical advice, that's just a really good book. But I'm not going to try and repeat all of that. But from what you're saying, Pat, look, I'd say I think these meetings, you're right. There is very busy time here. For both people, everyone is at limited capacity, and startups want investment, or they want the best investment, and investors want the best kind of startups to invest in. What I would say is, I saw this really good quote the other day on Twitter, and I can't remember who it's from, but they said, the not so secret secret of fundraising is just getting the next meeting booked in. So you should be planning your whole meeting just around getting another meeting, because momentum and excitement in my experience, are what raise rounds. Not like an exceptionally good pitch deck. That might make up part of it, but you need that kind of momentum going, and like, so you need to constantly be building the relationship with people. So just focus on getting the next meeting booked in and make sure that is a topic that you talk about at the end of that meeting. The second thing is, one point you mentioned, Pat, that I think is like so key. And it's interesting because, Pat and I are coming at this from very different angles. I focus so hard on relationship. I think relationships are the success in sales, in hiring, and in investment. So the better relationship you can build, the stronger your chances are of achieving any of those outcomes. So I always try and make the meeting very, very relationship heavy. So I might even err too much on the side of relationship because that's who I am, and I want to invest in the way that I am as a person, and invest my time and invest in those relationships. So the approach I always take in these meetings is, the first thing is that I always get the investor talking as much as I can because I want to learn about them. Actually, sorry, the first thing I do is I do a lot of due diligence. I want to understand what makes this firm different and interesting, or at least what makes them think they are different and interesting, so I can talk about that. So I come in very well prepared about this person, like, have they done podcasts before? It's like when I'm preparing for an interview on the podcast, I want to know about them. Like, do they have a weird blog? Were they in a band in high school that's out there in the world? Like, I want to know the unique things about them and the unique things about their fund. So I come in and I show that, and people, like Pat said, people like hearing that because it shows you did the work, but also it blows up their ego, man. Makes them feel special, which is great. Then when I first get into the meeting, I make it really about them for a while. I want to know about them. And when I say, tell me about yourself, investors will always just say, I'm Pat, I'm from S3, here's what our fund size is, here's what we're investing in. And there's the same pitch you'll get from everyone, which is, totally fine. Like, they talk about their USP, they talk about everything. I level deeper. I always ask the same questions. I say, first of all, tell me about yourself outside of that. And I see where that gets. And if it doesn't get me enough, I say, what kind of music do you listen to and what kind of books do you read? And it throws people a lot. And like, holy shit, like, what? And it'll just, I will then stick out in that memory, which I think is important. And it doesn't have to take a long time, but it starts to really, grow the relationship. Then I actually never go through a pitch deck in that first meeting, Pat. Now, I'm interested to see if you think this is a bad approach, but I never do a pitch deck. I try and lead a lot of information, a lot of points I want to get across from a conversational perspective. So I give the pitch, but I never give a pitch. I actually tell my story, because my story is so closely linked, my history with education and struggles in education and struggles in university and how that led to starting my business. And I tell all of the major pain points from my perspective. I then try and apply that to them and see where they've had those pain points. And then we talk about it at a global scale and what the TAM is and stuff like that. So I try and go through all those points to make people feel like, whoa, this guy fucking loves what he does. And then at the end, I try and, one thing I think is important is try and qualify this investor out. You don't want to waste their time, and you don't want to waste your own time. This person might be investing in Series A only, and you might be seed. Bad fit. Don't waste tons of time with them. So qualify them out, have a bunch of questions you want to go through, and make this learning from both perspectives. It's not just about giving information. And then at the end, get the next meeting. Absolutely get the next meeting. Book it if you haven't qualified them out. If they tick the boxes, so hey, let's catch up in a month. We're hoping to achieve XYZ in the next month. I'd love to give you updates on that in a month's time, or something like that. So get that next meeting booked in. What are your thoughts on that approach? Because it's a little bit different to yours. I think it kind of mostly overlaps though.
Yeah, no, I agree with a lot of what you said, and I think it all depends on the context, right? Like, if I have somebody that's like a cold outreach or something like that, it really depends how I met somebody. If I'm trying to think how you and I actually initially met. I know it was early when you first moved here and stuff. I think it was from my friend Turner at Sarin, actually. But that was, I think it's through a relationship or something, and we had sat down, grabbed coffee. It's a different ball game than, say, almost, I'm thinking if it's like a cold outreach or somebody's like, hey, you got to see this company. It helps to kind of have the pitch deck. But I think that, all depending on the context, building relationships is probably one of the most important part. Is probably the most important part of it. And Joel, you touched on a bunch of key things that now I'm thinking back through my meetings and some of the most successful ones. And a lot of the best relationships I've built with some of the people we ended up investing in were the ones that got to know you pretty well. Because they're not only just, it's not this transactional, like, I ask this question, you answer, you ask this question, I answer. It's more just like, hey, this is an acquaintance relationship I'm building with somebody, and even if we're not the best fit for them, I like this person, so I want to help them out. And one thing I think I'd add on that, you mentioned with qualifying the investor is, you might get to the end of the call and realize like, hey, this may not be the best investment firm for you, but one thing about VCs is a lot of their best friends are other VCs, right? So I was able to, and the best way they're going to get good deals is if they're like, hey, you might not be the best fit for us, but you're a badass company and you would be really good for this other fund. And then I'm able to make the introduction to this other fund that, really is more qualified to invest in you guys. And then they're like, man, that company that Joel was working on that Pat introed us to, that was awesome. Like, we got this great deal. We're looking for somebody else to come in. Like, let's try to get, if there was some overlap in that particular deal with our firm. So I would say, yeah, like not only qualifying them, but like if you get to a point in the conversation where you realize like, hey, maybe this isn't the right investment partner for me. This could be a good relationship for me to still have and not kind of discredit the call there and be like, listen, doesn't look like it might be the best fit from an investor side, or maybe let them kind of say that, but like, hey, is there other investors you think that might be better for us? Is there any companies in the space that might be able to use our product, or anything that kind of comes to mind, or any introductions you might be able to make that you think would be, pretty good for our business? Because like I said, I think one of the best things about working at VC was the relationships I built around the ecosystem, and the number of times that maybe myself wasn't able to help with something, but I was able to intro that person as somebody that was. It was pretty high, so I would add that as well. And like I said, I think a lot of the meeting just does depend on the context, right? Like there is a good way to focus more relationships informally, but if it's like more of a scheduled Zoom call, I would say, and maybe it's like a cold outreach, it would help to have a deck for them to walk through too. So I think it just all depends on the context, and you can kind of feel it.
I guess I'm not super anti-pitch deck. I always have a pitch deck open and ready to go through, but I never lead with it. I like to have it there depending on the vibe of the conversation. So you should be prepared for kind of like any potential outcome. And I very often send it as a follow-up, because then it's like, hey, we had this great interaction, and I'm giving you this like next thing, like another level of value, and like we had this great call, and now look how beautiful this pitch deck is. Like, look how like pretty the graphs are. So I think, yeah, you're right. Context is key. Like, it also depends on the investor. Some investors they don't want that shit, and you need to know that you can't force someone into having that relationship with you. So go down the path that makes the most sense. But look, I think there's a lot of really good context there. So I'm going to close this one out, and we're going to come to a final judgment here for rigid inclusion. So if I summarize this really quickly, it's, I guess, be yourself and take yourself into the meeting, because this is a relationship at the end of the day. And if you end up having an investor, like, you'll have them for a long time. So you want to make sure that you build a relationship from day one. I think also that shows that you're not like being really desperate too, saying like, we need cash. The second thing is use the context for the meeting, but I always like to lead with relationship first and pitch and deck second, but go with the flow of the conversation. Read the person, read the room, read the energy, and take the right kind of context in. And last thing is capitalize on the momentum. So if it makes sense to book another meeting in, get it booked in while you're in that call, or just immediately after. So do those things and make sure you capitalize on that momentum and move and keep building that relationship. Anything major missing that recap, Pat?
I think you hit it all pretty well. And like one of the things I just said was too, if you end up qualifying the investor out, try to understand if maybe they can introduce you to somebody else that might be pretty helpful. And yeah, that's
a great point. Do not burn that bridge, because that will fuck you. Investors talk. Awesome. All right. Well, rigid inclusions. That's it. That is your advice, and we'll move on there. All right. This next challenge is called valuation help. So I'm actually super keen on your insights on this one, Pat, because I've only done this once or twice or three times, like, whereas you've done this and thought about this, hundreds and thousands of times. So this is going to be a great mix. Yeah. So the question here is, sorry for the dumb question. I want to fundraise a seed round for 3 to 5 million and drive valuation up so we can get a Series A at 10 to 20 million. Generally, to get the VC funding, don't we have to convince them we could get a valuation at 20x their investment? If we fundraise for a 10 million investment, wouldn't we be aiming for a $200 million company? How do valuations even work? I always assumed you took your revenue per year and multiply it by 10 to get to 200 million. So does that mean we have to generate 20 million in revenue? I'm asking because I'm trying to come up with a convincing pitch deck that makes it clear we can generate 10x returns for investors. I can do napkin math to see how we could hit the 10 to 20 million revenue a year, but not sure how well I can convince a VC. Is that enough revenue to shoot for to get a 10 to 20 million investment? Are there some formulas we can use? I feel really dumb asking this, but it's been bugging me. What does success even look like? Info and criticism much appreciated. My feelings won't get hurt. From XYZ Trashman, ZYX. So, look, there's obviously a lot of nested questions there, but I thought it'd be useful to actually just see how do you think about valuation at these early stages? Because you're not always just thinking about your current valuation. You do need to think about where you're going and paint this story of, the next 5 and 10 years are going to look like blah, blah, blah. So, I don't know, how should a startup approach this and how should they think about valuation, Pat?
I think at the earlier stage, valuation can be a little bit more of an art than a prescriptive science. Like the later stage you get as a company, you're going to have more direct comparables. If you're a public company, obviously, like there's a lot that goes into that. But especially earlier on, like you should have the expectation that a lot of times the VCs will kind of start leading with the valuation or have something in their mind from a lot of the deals they've seen, or if you see there's a particular deal or a particular stage of the company at where you may feel like you're pretty comparable to, then you can kind of start thinking there. But I think a lot of times from our perspective, it was less about, was this going to be is this company, a $5 million, where are they at now? It was more about where could they be? Because especially from the VC side of the game, like our ball game was to hit home runs. It wasn't to really hit just singles, doubles, triples, and those kind of hits or those kind of focus is more on like the growth equity side of things, or the private equity side of things, where those later stage investors will try to take a company and be like, man, all right, we're here and we really see this, growing into this. Versus VC, it's like, we're going to invest early on. The only thing we know is that the story is going to change, right? Like we can try to throw a bunch of numbers behind it. And, especially at S3, like I was able to help a lot from the finances side. And that was one thing that our firm had tried to kind of bring, was more of a bench of kind of financial power. Just I come from the investment banking side. A lot of my coworkers were McKinsey consultants or whatever. But at the end of the day, like we could build a million models and a million different things, but the only thing you certainly know is that like the numbers won't be exactly what you put there. So I think from a valuation side, a few things to consider is, like I said, from the VC standpoint, it's like, hey, could this be a $500 million, could it be a $1 billion company? It doesn't have to be next year. It doesn't have to be in 3 years. It doesn't have to be in 5 years. It just, we got this particular time frame. Like, can it be this huge company by the end of the day? Because that's the whole bet, is like a lot of times a VC is going to make, say, 10 to 20 different investments in a fund, and, only 2 to 5 of them may end up being remarkably successful, and that can, return the fund really, really well. So I think one of the things is sometimes we'll see, when I was at S3 a lot of times, we'd see people try to get caught up with the numbers and try to put too much science behind it, when a lot of it is more dependent on really the stage of the company and also the market environment itself too, right? It was a lot different to raise money at the end of 2021 than it is now. And, I came on the S3 at a really unique time where it was like August of 2019, and we had a bit of a dip in activity right as COVID began, but then 2021 was this remarkable resurgence, and people were just throwing out these kind of astronomical valuations, and people just had different expectations then than they do now on, kind of what a company's valued. And I will add this too. One thing I think that a lot of startup founders aren't necessarily as considerate of, that I've seen kind of bite a lot of people in the ass in the long run, is trying to just get the highest valuation possible off the gate. Because a lot of times what happens is if you get an astronomical Series A or seed round valuation, you're going to be expected to grow into that, right? So I just remember seeing a lot of companies that would come to us when I was at S3 and them just, having these remarkable expectations in terms of valuations. And it's like, if the market environment was to stay as is through the years, then yeah, that'd be great. But the truth is, like, things came down a bit, right? And now you have a lot of companies, and you get this a lot more times. I think a little bit more frequently from what I've seen in like the California area than the Austin area, because I feel like valuations are a little bit more grounded here. I saw just a number of companies that had just raised at these astronomical rounds that if they decide to raise capital again, they're gonna have to take down rounds or like raise at these astronomical valuations. And then I think it was Instacart was raised at like a $37 billion valuation. They recently went public. I think they're around a $10 billion market cap now. I'll have to check the numbers there. I will still cut that out if that's not true. But it's just you got to be kind of aligned where you're at. But the biggest takeaway there is just understand that if you raise at a specific price, you're going to be expected to grow into it. And your thought process behind where you're raising now and like the price you're raising at is you're going to be paying for your father's sins down the road if you just try to get as much money at the highest price as you can. So that's also one of the benefits I think about working with a more grounded, sophisticated investor is they have their relationship on the line, so they're not going to try to just lowball you. They may give you a lower valuation than some other competing firms, but they may be like, hey, this is why we really see you're here. Their biggest goal is like, we're going to value here now. We want to work with you. We want to probably invest in the following round, this and that, but like, let's get up there steadily. Like you don't want to jump all the way up to the top step and then realize you're not there when you go to try to raise money again. So those are just kind of some of my thoughts. And like I said, I think especially now more than ever, or just really over the past few years now more than ever, I saw so many people raise these astronomical valuations, and it's gonna be really tough for them to kind of come back to earth or hit that valuation in the next fundraise. So it's all about kind of your expectations, the investor's expectations, as well as whenever we make an investment, we think about also like where do we need the company to be if we're gonna invest again the next round. So those are kind of some high level thoughts there, Joel. I'll turn it back to you and kind of get your thoughts.
I love it. I think when you talk about these astronomical valuations, one important thing to know here is like, and I know this kind of makes sense, but it's just really important to remember, investors put money into a company so that in the future they can take more money out of the company. So that means whatever they invest in now and the valuation they give you now, you need to become worth much more in the future for them to get their money out in like multiples. And like that's why there are all these rules and formulas and all that kind of shit that like are kind of out in the world. But like if you raise at $100 million valuation and you can never get a higher valuation, or you can never go public for higher than that, or you can never get bought for more than that, that means you as a founder are probably never going to get any money out of your company. And your investors will get like less money out of their company. So you need to be really conscious of like how much you're worth now and what your potential is. The next thing I would say is, Pat, you mentioned this too, but like investors are really investing in potential. They don't give a shit about where you are right now. They're thinking about like, what is this going to be worth in the future? So what is the potential market size for this? How confident am I in this founder's ability to grow the right team? And like, so I guess like founders are really thinking about what is the opportunity here? And like, how certain am I that they can actually do this? And it's really as simple as that. And that's why it does actually come down to an art. And what I would say though, is that like, it is more of an art than a science. But that being said, there also are rules that people kind of default and everyone talks about in the process, even though the rules aren't actually used. It's kind of like this weird dance that founders and investors go through that both sides know is fake. But it's like they do this like weird dance where they're saying stuff and not really saying stuff like the whole time. So like what I see from my own experience and from my founder friends is that generally you want to like every round you give away like 20%. So you want to make sure that your valuation is 5 times higher than the amount of money that they're giving you. Then you need to come up with some kind of reasonable multiple so of your revenue. So like say you want to raise $10 million, well, that means you need to probably be worth around $50 million because that's 20% of the company. And then to raise $50 million, that valuation generally gets simplified at the end of the day to your revenue. And if you're like an AI startup or you're a consumer startup that's about users, that's a little bit different. But generally when you've got like a revenue in a business, it's worth like some kind of multiple somewhere between like 5 and 50, depending on like how excited people are about your company. But generally you go like 10-ish. So to raise at a $50 million valuation, you need to be at $5 million of revenue. Now there are just rules of thumbs, and that's like kind of the process that it gets boiled down and simplified to. But that's actually not real. And then you also need to show people like, hey, here's where we are now, but here's how we are very confidently going to get to 50 million and 100 million and $1 billion in revenue. And again, that's not real. What investors and founders both know is that you need to have that plan, but that is not how it's going to work out. But you just need to show that, you are forward thinking and you have a reasonable amount of due diligence done on yourself about how you're going to grow and what the opportunity looks like. And it's all about just growing confidence in your business and your ability to think and problem solve and to plan and your strategic chops. And I think that's really what it boils down to. So I think the real thing that investors are investing in is, at these early stage, is excitement. So like, holy shit, this could be massive. And everyone else wants to invest. And where I think valuations are actually made is competitive tension. So if Pat's the only investor looking to invest in my business, he's probably going to be like, oh, why am I the only investor actually? Like, that's kind of sus, let's hedge our bets and bring the val down. But I'm sure, if it looked like everyone wanted me and I had like 100 offers on the table, Pat would be like, you know what, actually we can go up. We actually can push that price up a little bit because we've got all this external validation. So that's a very, I guess, Pat, my answer is pretty different to yours from a different angle, but I think like the whole investment evaluation process is kind of made up, and it's about excitement at the end of the day. There are rules and stuff you can follow, but it's about like, what's the potential and how are you going to get there? And like, how confident are that these are the right founders to get there?
No, I definitely see I definitely agree with that from especially a very early stage standpoint, just because there's so much unknown. And like I said, I think a lot of times where we were at S3, we were probably a stage later than the very earliest stage. So I'm kind of taking that question from that standpoint. But if we were to say no, a lot of times it would be like, just because we can't see this being $1 billion company, right? There's no way you're going to get there. Nobody invests as a VC hoping for the company to just be a $10 million company and that's it, right? Like I said, our game we're playing is we're swinging for the fence, and that's the whole model of it. Is like, that because you're taking this greater inherent risk earlier on, because there's less figured out, you're going to want more reward. You're going to want the chance of more upside. So that's just that, at least from the VC side, is where we're at. And you touched on a good few things that I think I'm glad you brought up, because we're definitely worth mentioning. Like, especially as the more mature you get as a company, a lot of times valuation will be pegged off some revenue multiple, some user growth, something like that. There is an art of science there too. So there's an element of science there too. But the early, right when you're getting going, like I said, a little bit more, so much more is on the potential of it.
Yeah, like there actually are formulas. The thing that makes it more of an art though is that all of the parameters in the formulas can change dramatically depending on external factors. So it's like your valuation is built off like revenue or user growth. But like, what are the multiples? Well, that's dependent on like, are these founders experienced or not? Has their growth to date been insane? Is the market size massive? Is the technology novel? Are there patents? Like, so all these things get taken into consideration, and it is just a conversation and as you go through it. But to be honest, I actually don't think I can even really summarize this well, but I'll give it a crack. Here's our final judgment. Trash man. I get it, man. This is actually a hard, weird space to learn. And the advice I'll give you is go and speak to as many founders as you can to work out how they do this and how they talk about it, so that you can sound sophisticated when you're going to talk to investors. Also find friendly investors, find investors that probably aren't going to be a good fit. They'd be more than happy to have a chat with you and actually, have the conversation and teach you how to go through this and to position yourselves and what stuff looks like. And get mentors and coaches and advisors, because they can really help you through this process as well, I think. So, that's all I'm going to say. The rest of it, is so mixed and varied, because it is, how do you paint the Mona Lisa? Like, who knows? What makes beautiful art? I'm not sure. There's so many kind of, weird things out there that you need to take into consideration. Awesome. All right, well, we're going to close that one out. Trash man, that's your advice, Take all of that and work out what applies to you and how you can kind of move forward. And, Pat, we've gone really deep, so we actually have no time for other questions, so we'll jump into plugs now. So this is my favorite part of the show, but what's going on? What's going on in your life? What do you want to plug right now? What do you want to recommend and promote?
If you're out at a bar or restaurant and you see Atmosphere or Chive TV on, that's probably our most popular channel, just, maybe make a comment to the bar owner or the manager, whoever, say that you enjoy the content. That obviously we love that there too. But also to probably, if I'm gonna plug one other thing, if you're in Austin, if you're a founder, if you're a VC, definitely come out to my happy hours, my different events. It's my favorite thing to do here. I love hosting it. It's such a special community. If you have just moved here, you're looking to get integrated with the scene, feel free to reach out. We'll put my LinkedIn in the notes. I can add my email as well. And yeah, I think it's just, one of my favorite things is getting people involved in the scene. It's such a special city and such wonderful people. And it's been so great for me, and I hope it's so great for everybody that moves here too.
I love it, man. What nice plugs. That's so nice. I'll also put all the Pat's socials and stuff into the show notes too, so you can follow Pat and see when all this stuff's coming up as well. And look, on my side, pull out your phone right now. Press like. Press subscribe. Go to YouTube, go to Spotify, go to Apple Podcasts, go to all of them and do all of the good stuff and rate and review. We really appreciate that. And as always, we condone stealing, so steal someone else's phone and like and subscribe on their phone too. And then give it back because they'll also love listening to the show. And if you have any questions, write them in. Send them through to podcast@joeldtrapani.com and we'll workshop them with our future guests and it'll be a lot of fun. And lastly, if you want to just have a chat with me, I love chatting to people, love chatting to the audience. If you've got product problems, startup problems, you're just interested in the space, you got questions, I've got a booking link. Let's just book some time and get on a call. I'd love it. And so we're going to wrap this one up. Pat, mate, thank you so much for coming on. Thank you for helping us peek under the hood of what it looks like in an investment firm and all these kind of tricks and tools that you've learned over the years that investors and founders can use together. It's been a lot of fun. So, man, thank you so much for sharing all of that.
Thanks for having me, Joel. The train's about to come too, so it's a good time to jump.
Well, look, this has been another episode of the Do As I Say, Not As I Did podcast. We'll see you all next week.